Today we're going to talk about inflation, how it works, and how you can protect yourselves against it and actually increase your purchasing power. My name is Eric Martel. Over the years, I've done over $85 million of real estate transactions. I'm the co-founder of MartelTurnkey and FlipSystem.com, and I'm here to help you make more money and help you start thinking like an investor. And to help you start thinking like an investor. And guess what investors do? Invest. That's right. All right, let's get into it. So what is inflation? Let's talk about that. Well, basically it's an increase in prices, which means an increase in your cost of living. It's caused by something very simple, very basic. It's supply and demand again. You go to the store and the prices of cookies is more expensive than last month. Well, why is that? It could be because the demand went up. The store owner notices that more people, more customers want to buy these cookies, and they say, hey, what's going on? I'm going to increase the price a little bit for these cookies. And this is exactly what happens, but at a larger scale. It could also be the supply is going down. The cookie factory has some problems. They can't produce as many cookies, but the people still want those cookies. Then the store owners knows about that. They're trying to buy cookies to put them on the shelf, and they just can't keep enough on the shelf. So they decide to raise the prices to kind of like balance out the supply and demand. These are just the normal kind of things of supply and demand. We've experienced that during the pandemic. We saw the demand going up for home office equipment because people had to work from home. We saw people that they couldn't go to the gym during the pandemic, so they started buying fitness equipment. We couldn't get weights for your gym those days because it was so difficult to get, and if you were able to get them, they were very expensive. We also saw something similar with masks and sanitizers. Also during the pandemic, in terms of the supply, having issues with the supply, we saw computer chips being affected and affecting the prices of cars and cell phone. There was car lots full of cars that they couldn't sell because they didn't have computer chips. So that really decreased the supply of cars, and then the price went through the roof with the cars and the cell phone. So this is kind of like the basic mechanism of supply and demand and how it creates inflation. How do we measure that? Well, CPI is the one that we probably know the best, that we've heard a lot about. And basically, it's a basket of goods. The Bureau of Labor Statistics is the one compiling this basket of goods. And every once in a while, they change it. They don't change it very frequently. They kind of look at what's happening in the economy, how people are spending money. And that basket of goods basically determine how prices are changing, and this is how the CPI is calculated. But that basket of goods is all about consumption. So that means that it's really about how each individual is going to the store, how they're purchasing things. It doesn't include income taxes, and notably, it also doesn't include anything that the government or the employer is paying for. For example, healthcare. So it doesn't include these costs in there. Inflation is also personal. So when you look at that basket of goods and you look at how it's being split up in the different categories. So here I have the basket of goods for the current CPI basket, and the shelter is about 35.8%, commodity is 18.9%, and energy is like 6.65%. You can also see that each of these categories have a different changes in prices. Shelter, the prices went up from January 2023 to January 2024 at about 6%. Commodities went down a little bit by 0.3%. Energy went down by 4.5%. So each categories have different impact on the CPI or the inflation as it is measured today. Which means that how I spend my money, this is why I often say like inflation is personal, because how I spend my money means that I have a different allocation of these the categories, which means that my inflation could be lower or higher than the CPI, the way that it's measured. So for me personally, if I look at my expenses, so I spend a little bit more on shelter, about 40% on shelter, commodities 15%, but I don't spend I don't spend anything on the transportation per se. I spend on energy and stuff like that, but I don't spend too much on transportation. So my inflation rate, instead of being the 3.1% that's currently quoted by the Bureau of Labor Statistics, I'm more around the 3.6%. Also, the CPI is also something that depends on the city. So different cities have different inflation. So Miami, for example, Fort Lauderdale, where I live, the CPI there is about 5.7%, and if you go to San Francisco, is 2.5, 2.6% with LA as well. So lower inflation in these markets, higher inflation where I am in Miami, Fort Lauderdale area. So where you live also is something that matters. The Fed is looking at something a little bit different. You may have heard about it, is the PCE, the Personal Consumption Expenditure. And this is a national measure, and it changes all the time. What is included in that changes all the time because it's based on the National Spending Database. So they're connected to that National Spending Database, and they measure the impact on inflation. And this is what the Fed is using. It's a much more dynamic measure, and their inflation there is around 2.4%. So that's how they measure the inflation there. So this is how it's measured. And even when you look at that, we look at the CPI, you look at the PCE, and these numbers really don't, how do they affect me? And this is really why I start talking about the treadmill example. So I'm on a treadmill, and if there's zero inflation, the treadmill is basically not on. It's not working, it's not turning, and I can just stand still, and I'm basically staying in the same place. Once the inflation gets started, that means that the treadmill starts rolling, and that means that if I want to stay in the same place that on the treadmill, that means I have to move. I have to start walking, and this is to maintain basically my purchasing power. The higher the inflation, the faster the treadmill goes, the more work I have to do in order to stay in the same position on the treadmill in order to maintain my purchasing power. So this is kind of like how it affects me. And what does it matter? So, it's just like I can say that, oh yeah, the inflation is great. Okay, well, that's fine. It affects my price, but why do I need to worry so much about that? Yeah, I have to work a little bit harder, but really it's such a small amount I don't have to worry about it. But it just can't be ignored because it's, it could be raining outside and you can decide to ignore it and pretend that it's sunny, but you're still going to get wet. It's affecting your ability, and it will affect your ability to buy things in the future, what you can afford. If you take an extreme example, imagine that your income doesn't go up in the next 20 years, right? But the price of everything else goes up by 5% per year. So your $5 Starbucks coffee will cost you $13.25 20 years from now. 20 years from now, you're going to have to make some serious decisions about how much coffee you intend to consume. So this is why it's important to pay attention now so that you can at least maintain your purchasing power over the next few years, or maybe even find a way to increase your purchasing power over that same period of time. There is something you can do, and this is what we're going to talk about in this video. Right? You can protect yourself against that inflation and actually increase your purchasing power. If you look historically, I have a graph here from from the Bureau of Labor Statistics, and it shows the blue line here, the top line, is actually a measure of inflation, the PCE that I mentioned, and then the red line is actually the median household income. And you can see very quickly that there's a big gap, and the gap is getting bigger between the price of goods and your increase in salary. That means things are getting less and less affordable over time. And I think that we've all experienced that, and we've all talked about it. And if you want to change that dynamic, you want to make sure that you do something to make sure that you maintain that purchasing power. Otherwise, the dynamics right now, if you don't do anything, is that you're going to be losing purchasing power if you don't do anything. So this is something that's why you need to do something about that. But what can you do? Well, the typical strategy is basically put some money under your mattress or money in the bank and then just leave it there and hope for the best. But that doesn't really work that well. And this is how I can illustrate that. So let's say you have $25,000 in cash right now. And you could go and use that money, and you can go to Starbucks or your favorite coffee shop and buy buy as many coffees as you can with that money. Let's say the cup of coffee is worth $5 today. You can buy 5,000 cups of coffee. And we're going to measure the effect of the purchasing power by looking at how much coffee can you buy, 5 years down the road with a 3.3% inflation rate. This is a very small inflation, right? And then, so let's talk about it. So you take that $25,000, you put it in your sock drawer. Every day you go and put your socks on. You can see that $25,000 in your sock drawer. It looks the same. It looks exactly the same. It's the same dollar bills and then all of that. You do that every day for 5 years. 5 years down the road, you put your socks on. You say, today I'm going to go and get some coffee. And you look at that money. It looks identical than what it was before, 5 years ago. And now you go to the store, but the price have changed. Now that cup of coffee, instead of being $5, is $5.80. That means that you can buy only 4,300 cups of coffee instead of the 5,000 that you could have bought earlier. You've lost purchasing power about 687 cups of coffee. This is to illustrate how inflation is actually eroding your purchasing power. So leaving it in the bank, leaving it in your sock drawer or under your mattress is not the right way to do it. But if you invest in real estate, this is what it looks like if you invest in real estate. So that same $25,000 today, again, I could buy 5,000 cups of coffee, but instead of doing that, instead of putting it in my sock drawer or in the bank, I invest it in real estate. I buy a $100,000 single-family rental. I get a loan for it. I put a $20,000 down payment, and I basically spend $5,000 in fees, closing costs, and all that kind of stuff. So this is money I don't have anymore. And I have equity at the beginning of $20,000. So I'm actually kind of starting a little bit lower than I was before. But this is how I spend my $25,000. That $25,000 is generates on that property. It's going to generate rent. I have mortgage payment. I have all kinds of other costs. And my net cash flow is $240,000 at the beginning. That cash flow is going to increase over time. I'm going to accumulate that net cash flow interest-free. But a couple of things that happen. That house appreciates. That $100,000 house appreciates over time. And after 5 years, that house is now worth $115,000. I'm also paying my mortgage. I'm paying down my mortgage. And now the loan balance is $79,000. So I've gained a little bit of equity on that on the loan. My total equity is now $36,784. I started with 20 and now I have 36, almost doubled. On top of that, I have the accumulated net cash flow from the rental. So that's $20,000 over a 5-year period. So the total value at the end of 5 years is $56,000. I started with 20 and now I'm at $56,000. Now I decide to go to the store with that money, and at $5.80 per cup of coffee, I can buy 9,797 cups of coffee. You can see that I have increased my purchasing power. I can buy almost twice as many cups of coffee as I could 5 years earlier. A significant increase in purchasing power. This is why it's important to really pay attention to inflation. This is what you can do to improve and increase your purchasing power over time. You need to invest in a leveraged real estate investment. Now you understand what inflation is and how to protect yourself. But none of this matters unless you take action. Investing today is always going to be better than investing tomorrow, because every day you wait, inflation is eating your money away. If there's anything you're going to take away from this, is you need to take action now. Now I understand for some people, investing in real estate can feel intimidating. For those of you who feel that you can use some more assistance, one of the companies that I co-founded, called FlipSystem, helps you exactly with that. I started FlipSystem because I know that real estate investing can feel intimidating. So FlipSystem is a one-stop shop for real estate investors. We provide resources, funding, industry connections, software, coaching, and properties. If you think that this could be a good fit for you, make sure you check it out at FlipSystem.com. Otherwise, subscribe for more investing videos and see you on the next one.